Offences and penalties under Income Tax Act. Penalties are levied for various defaults committed by the taxpayer. Some of the penalties are mandatory and a few are at the discretion of the tax authorities. Here we are discussing about the Finance Act 2021 applicable for the assessment year 2022-2023, which is respect to the financial year of 2021-2022. So, Section 140A subclause 3. Section 140A subclause 3. Failure to pay wholly or partly self-assessment tax or interest and fee or both under Section 140A subclause 1. Such offence can be penalized with an amount as assessing officer may impose but not exceeding tax in arrears. So here the amount of penalty is at the discretion of the assessing officer, but this may not be exceeding tax in arrears. Then we have 158 BFA subclause 2, determination of undisclosed income of block period. Section 158 BFA subclause 2, determination of undisclosed income of block period. So the penalty will be minimum 100% of tax leviable in respect of undisclosed income. That is the minimum one. The maximum will be 300% of tax leviable in respect of undisclosed income. Section 221 subclause 1. Section 221 subclause 1, default in making payment of tax. Such amount as assessing officer may impose but not exceeding amount of tax in arrears. So the Section 140A subclause 3 and Section 221 subclause 1 are similar but different. Here Section 221 subclause 1 discusses about default in making payment of tax, and the penalty will be such amount as assessing officer may impose but not exceeding amount of tax in arrears. Section 234E. Section 234E. It says about failure to file statement within time prescribed in Section 200 subclause 3 or in proviso to Section 206C subclause 3. Once again, failure to file statement within prescribed time. And where it is mentioned in Section 200 subclause 3, the time prescribed as in Section 200 subclause 3 or in proviso to Section 206C subclause 3. And the penalty will be Rs 200 for every day during which failure continues but not exceeding tax deductible or collectible. Now Section 234F. Section 234F. Default in furnishing return of income within time prescribed in Section 139 subclause 1. So in 234E, it was failure to file statement within time prescribed in Section 200 subclause 3 and in proviso of Section 206C subclause 3, that is Section 234E, and in 234F it is default in furnishing return of income within time prescribed in Section 139 subclause 1, and the penalty here will be a higher penalty as compared to 234E. Here the penalty is Rs 5,000 if return is furnished after the due date. This is amended by the Finance Act 2021 but applicable from assessment year 2021. Now, it is to be noted that if a total income of the person does not exceed 5 lakh, then fee payable shall be only 1,000 rupees. So 5,000 is if the income of the person is above 5 lakh. If the total income of the person does not exceed 5 lakh, then fee payable shall be rupees 1000. Now section 270A subclause 1, underreporting and misreporting of income. A sum, here the penalty will be a sum equal to 50% of the amount of tax payable on underreported income. So if it's underreported, a sum equal to 50% of the amount of tax payable on underreported income. However, if underreported income is in consequence of any misreporting thereof by any person, the penalty shall be equal to 200% of the amount of tax payable on underreported income. So 270A subclause 1 discuss about underreporting as well as misreporting of income, whereas underreporting has a fine of 50% of the taxable amount. The penalty will be will be equal to 50% of the taxable amount on the underreported income, but the penalty will be more intense when it comes to the case where the underreporting happens as a consequence of misreporting of income. Here the penalty and the liability is more. The penalty is 200% of the amount of taxable income on the underreported income. Now that was section 270A subclause 1. Next, section 271 subclause 1B. That is section 271 subclause 1 subclause B. Failure to comply with the notice under section 115 WD subclause 2 or 115 WE subclause 2 or 142 subclause 1 or 143 subclause 2 or failure to comply with the direction under 142 subclause 2A. So here the basic thing is failure to comply with the notice, and the sections discussed here is 115 WD subclause 2, 115 WE subclause 2, 142 subclause 1, 143 subclause 2 and 142 subclause 2A. All the sessions discuss about notice, whereas 142 subclause 2A discuss about the direction. So non-compliance to these notice and direction is the offence committed, and this is discussed in section 271 subclause 1 subclause B, and the penalty will be fixed at rupees 10,000 for each failure. Now 271 subclause 1 subclause C. Concealment of particulars of income or fringe benefit or furnishing of inaccurate particulars of income or fringe benefits. So 271 subclause 1 subclause C. Here concealment of particulars of income or fringe benefits or furnishing of inaccurate particulars of income or fringe benefits. Here the minimum penalty would be 100% of the taxable amount, and the maximum will be 300% of tax sought to be evaded in addition to the tax payable. Now section 271 subclause 4. Distribution of profits by registered firm otherwise than in accordance with partnership deed and a result of which partner has returned income below the real income. So 271 subclause 4. Distribution of profits by registered firm otherwise than in accordance with the partnership deed and as a result of which partner has returned income below the real income. Here the penalty will be not exceeding 150% of the difference between tax on partner's income assessed. That it is to be noted that it is not exceeding 150% of the difference between tax on partner's income assessed and tax on income returned, in addition to the tax payable. Now section 271A. Here failure to keep, maintain or retain book of accounts, documents, etc. as required under Section 44AA. Section 271A, failure to keep, maintain or retain book of accounts, documents, etc. as required under Section 44AA. Here the penalty will be 25,000. Now, Section 271AA subclause 1. Here three main types of offences are discussed. That is 1. Failure to keep and maintain information and documents required by this section 92D subclause 1 or 92D subclause 2. The second one is failure to report such transaction. Third, maintaining or furnishing incorrect information or documents. So this section mainly deals with the maintaining of information and documents. The first one is failure to keep and maintain information and documents required by the section 92D subclause 1 or 92D subclause 2. The second is failure to report such transaction, and the third one is maintaining or furnishing incorrect information or documents. Here the penalty will be 2% of the value of each international transaction or specified domestic transaction entered into. Now, Section 271AA subclause 2. Here, failure to furnish information and documents as required under Section 92D subclause 4. Here, the penalty will be 5 lakh rupees. Now, Section 271AA. Section 271AAA. Here, where search has been initiated before 1/7/2012 and undisclosed income found. Here, the penalty will be 10% of undisclosed income. The next section is 271AAB subclause 1. That is 271AAB subclause 1, where search has been initiated on or after 1/7/2012 but before 15/12/2016 and undisclosed income found. Here we have three options for penalty. A. 10% of the undisclosed income of the specified previous year if assessee admits the undisclosed income, substantiates the manner in which it was derived, and on or before the specified date pays the tax together with interest thereon, and furnishes the return of income for the specified previous year declaring such undisclosed income. So in that case, the penalty will be 10% of the undisclosed income. Just to be noted, in Section 271AAA, we discussed about where the search has been initiated before 1/7/2012 and undisclosed income found. In 271AAB subclause 1, we are discussing about on or after 1/7/2012 but before 15/12/2016. So, if the defaulter has admits the undisclosed income, substantiates the manner in which it was derived, and on or before the specified date pays the tax together with the interest thereon, and furnishes the return of income for the specific previous year declaring such undisclosed income, then his penalty will be only 10% of the undisclosed income as discussed in 271AAA, similar to that. But if assessee does not admit the undisclosed income and on or before the specified date declares such income in return of the income and furnishes, means if he defaults to accept it and do the necessary action, the penalty will be 20% of the undisclosed income. Now, if it is not covered by A or B, there is a situation where the scenario is not covered by the option A or B. In A, we discuss about 10% penalty and B 20% penalty. If the scenario doesn't fall on either one, then we have option C, where the penalty will be 60% of the undisclosed income of the specified previous year. Now, section 271AA(b) subclause 1A. 271AA(b) subclause 1A. So, in section 271AAA, we discuss about search that has been initiated before 1/7/2012 and undisclosed income was found. In 271AA(b) subclause 1, we discuss about where the search was started on or after 1/7/2012 and ended before 15/12/2016 and undisclosed income was found. Now we have 271AA(b) subclause 1A where search has been initiated on or after 15/12/2016 and undisclosed found. So here the tax liability a bit more higher. That is 30% of the undisclosed income of the specified year if assessee admits that if the assessee admits to the undisclosed income, substantiates the manner in which it was derived and pays the tax as well as the interest on or before the prescribed date for the specified previous year, then 30% of the undisclosed income will be the liability for him, tax penalty for him. And if he does not do it, 60% of the undisclosed income of the specified previous year in any other case. And then we have so discussing about the timeline, we have 3 period, that is where search has been initiated before 1/7/2012 and undisclosed amount found. Then from 1/7/2012 to 15/12/2016 and undisclosed amount found. And then we have on or after 15/12/2016 and undisclosed income found. So the penalty has been been on the rise from case 1 to case 3. In the case 1 it was 10%. In case 2 where it is the period on or after 1/7/2012 to 15/12/2016 and undisclosed income found. There were 3 scenarios for the cases. If the assessee admits the undisclosed amount, shows the substantiates the manner in which it was derived and pays the files the return and pays the tax as well as the interest for the specified previous year, then it will be 10%. That is the lowest penalty in this case. And then if he does not admit and if he does not substantiates the manner or file the tax and the interest on a does not file the return of the income, then it will be 20% of the undisclosed amount. And if there is a scenario where the default doesn't fall in case A or B, then there is a option C where the penalty will be 60% of the undisclosed income. Now the case 3 scenario is where the search was initiated after 15/12/2016. So it is applicable even now. It is ongoing. There is end limit has not been mentioned for it. So here the penalty is of 2 types. If the person admits to the undisclosed amount and substantiates the manner in which it was derived and files the return and pays the tax along with the interest thereupon, then the penalty will be 30% of the undisclosed amount. And if he defaults in it, then 60% of undisclosed income will be the penalty. Now in section 271AA(c), income determined by assessing officer includes any income referred to in section 68, 69, 69A, 69B, 69C or 69D for any previous year if such income is not included by assessee in his return or tax in accordance with the section 115 BBE has not been paid. So section 68, 69, 69A, 69B, these are the sections that has been discussed here. That is 68, 69, then 69A, B, C, D, 69A, 69B, 69C, 69D. If all the income are coming under these sections, the income was determined by the assessing officer, but the taxpayer has not included these and filed return or tax in accordance with the 115 BBE, that will be, this is an offense or a default, and the penalty will be 10% of the tax payable under section 115 BBE. Now, section 271 AD, penalty for false entry in books of accounts, and that is without prejudice to any other provisions of this act, if during any proceeding under this act it is found that in the books of accounts maintained by any person there is false entry or an omission of any entry which is relevant for computation of total income of such person to evade tax liability. So, false entry or omission, these are the two things considered here. So, false entry or omission of what? Omission of an entry which is relevant for the computation of the total income. If such an offence is committed, the penalty will be a sum equal to the aggregate amount of such false or omitted entry. Now, section 271B, failure to get accounts audited or furnish a report of audit as required under section 44AB. So, here the penalty will be 1/2% of total sales, turnover or gross receipts, etc., or 1,50,000, whichever is less. So, it is remembered whichever is less. It can be 1/2% of the total sales, turnover or gross receipts, etc., or 1,50,000, whichever is less. That is failure to get accounts audited and furnish a report of audit as required under 44AB. Now, section 271BA, failure to furnish a report from an accountant as required by section 92E. So, in 271B, we discuss about audit report, and in 271BA, we are discussing about a report from an accountant as required by 92E. Audit report is discussed under 44AB, and accountant report is required by section 92E, and here the penalty will be 1 lakh. Section 271BB, failure to subscribe any amount to units issued under scheme referred to in section 88A. Here the penalty will be 20% of such amount. Now, section 271C, failure to deduct tax at source, that is TDS. Failure to deduct tax at source wholly or partly under section 192 to 196D. That is discussed in chapter 15, chapter 17B. So, under section 192 to 196D, chapter 17B, or failure to pay wholly or partly tax under section 115 or subclause 2 or second proviso to the section of 194B. In such a case, the penalty will be amount equal to the tax not deducted or paid. So, here we discuss about tax failure to deduct TDS wholly or partly, and two important portions of sections are discussed. One is under chapter 17B, 192 to 196D, or 115 or subclause 2 or second proviso to 194B. Then the penalty will be amount equal to the tax not deducted or paid. Then section 271CA, failure to collect tax at source as required under chapter 17BB. So here failure to collect tax at source, TDS again, as required under chapter 17BB, and here the penalty will be amount equal to the tax not collected. Now, section 271D, taking or accepting any loan or deposit or specified sum in contravention of the proviso of section 269 SS. Specified sum means any sum of money receivable, whether as advance or otherwise, in relation to transfer of an immovable property, whether or not the transfer takes place. Now, here the penalty will be amount equal to the loan or deposit or specified sum so taken or accepted. So, the default is what? What is the offence here? Taking or accepting any loan or deposit or specified in contravention of the provisions of section 269 SS. So, it becomes an offence when it is in contravention of the provision of section 269 SS. that is discussed in section 271D, and the penalty will be amount equal to loan or deposit specified sum taken or accepted. Now in section 271DA, receiving an amount of Rs 2 lakh or more from a person in a day, that is discussed under section 269ST, receiving an amount of Rs 2 lakh or more from a person in a day, and the penalty will be amount equal to such receipt. Now section 271E, repayment of any loan or deposit or specified advance otherwise than in accordance with provisions of section 269T. So what is specified advance? Means any sum of money in nature of advance by whatever name called in relation to transfer of an immovable property, whether or not transfer takes place. Now here the penalty will be amount equal to the loan or deposit or specified advance so repaid. Now section 271FA, failure to furnish an annual information return as required under section 285BA subclause 1 subclause 2. Also, failure to furnish annual information return within the period specified in the notice. So, you should furnish the annual information return as required, and it should be filed within the time period. So, if you fail to do so, if you don't furnish the information, the penalty will be 500 per day of default, and if it's not done within the period of prescribed time specified in notice, then the penalty will be 1000 per day of default. Now section 271FAB. Here section 9A provides that the fund management activity carried out by an eligible offshore investment fund through an eligible fund manager acting on behalf of such fund shall not constitute business connection in India, subject to certain condition. The proviso requires that eligible investment funds shall furnish within 90 days from the end of the financial year a statement in respect of its activities in a financial year in the prescribed form containing information relating to the fulfillment of specified conditions and such other information or documents as may be prescribed. Penalty to be levied if investment fund failed to comply with the requirement. The penalty will be 5 lakh rupees. Now, section 271FB, failure by an employer to furnish the return of fringe benefit as required under section 115 WD, and the penalty will be rupees 100 for every day of default. Section 271G, failure to furnish any information or document as required by section 92D subclause 3, and the penalty will be 2% of the value of the international transaction or specified domestic transaction for each failure. Section 271GA. Here the offences to section 285A provides for reporting by an Indian concern if the following two conditions are satisfied. Condition 1. Shares or interest in a foreign company or entity derive substantial value directly or indirectly from assets located in India. And condition 2, such foreign company or entity holds such asset in India through or in such Indian concern. In this case, the Indian entity shall furnish the prescribed information for the purpose of determination of any income accruing or arising in India under section 9 subclause 1 subclause I. In case of any failure, the Indian concern shall be liable to pay penalty. So here penalty shall be A sum equal to 2% of the value of transaction in respect of which such failure has taken place if such transaction had effect of directly or indirectly transferring right of management or control in relation to the Indian concern, and B a sum of 5,000 in any other case. Now section 271GB subclause 1, failure to furnish report under section 286 subclause 2. Here the penalty levied is 5,000 per day up to 30 days and 15,000 per day beyond 30 days. That is section 271GB subclause 1, failure to furnish report under section 286 subclause 2. Penalty will be 5,000 per day up to 30 days and 15,000 per day beyond 30 days. Now section 271GB subclause 2, failure to produce the information and documents within the period allowed by the section 271GB subclause 6. Here the penalty will be 5,000 for every day during which the failure continues. Now section 271GB subclause 3. Failure to furnish report or failure to produce information or documents under section 286 even after serving order under section 271GB subclause 1 or 271GB subclause 2. Then the penalty will be 50,000 for every day for which such failure continues beginning from the date of serving such order. Now section 271GB subclause 4. Failure to inform about inaccuracy in report furnished under section 286 subclause 2 or furnishing of inaccurate information or documents in response to notice issued under 286 subclause 6. Then the penalty levied will be 5 lakh rupees. Now section 271H. Failure to deliver or cause to be delivered a statement within the time prescribed in section 200 subclause 3 or the proviso to section 206C subclause 3 or furnishes incorrect information in the statement. Here the penalty will be with effect from 1/10/2014. Assessing officer may direct payment of penalty. Penalty shall not be less than 10,000 but may extend up to 1 lakh. In section 271I, as per section 195 subclause 6 of the Act, any person responsible for paying to a non-resident or to a foreign company any sum, whether or not chargeable to tax, shall furnish the information relating to such payment in the form 15CA and 15CB. Penalty shall be levied in case of any failure. The penalty will be rupees 1 lakh. Section 271J. Furnish incorrect information in any report or certificate by an accountant or merchant banker or registered valuer. Here the penalty will be 10,000 for each incorrect report or certificate. Now section 271K. Penalty for failure to furnish statement by the research association, university, college or other institutions, etc. Here the penalty will be a sum not less than 10,000 but which may extend to 1 lakh. Now section 272 subclause 1. Refusal or failure to answer questions, sign statement, attend to give evidence or produce book of accounts, etc. in compliance with the summons under section 131 subclause 1. Comply with notice under section 142 subclause 1, 143 subclause 2 or failure to comply with directions issued under 142 subclause 2A. Here the penalty will be 10,000 for each failure or default. Section 272 subclause 2. Failure to furnish requisite information in respect of securities as required under section 94 subclause 6. Give notice of discontinuance of business or profession as required under section 176 subclause 3. Furnish in due time returns, statements or certificates, delivered declaration, allow inspection, etc. under section 133, 134, 139 subclause 4A, 139 subclause 4C, 192 subclause 2C, 197A, 197A, 203, 206, 206C, 206C subclause 1A and 285B. Deduct and pay tax under section 226 subclause 2. File a copy of the prescribed statement within the time specified in section 200 subclause 3 or the proviso to the section 206 subclause 3 up to 1/7/2012. File the prescribed statement within the time specified in 206 1A subclause 1. Failure to deliver or cause to be delivered a statement under section 200 subclause 2A or section 206C subclause 3A within the prescribed time. With effect from June 1, 2015, it is mandatory for an office of the government paying TDS or TCS as the case may be without production of challan to deliver a statement in the prescribed form and manner to be prescribed authority. Now, defaulter will be penalized with 10,000 for each failure or default in respect of penalty for failure in relation to declaration mentioned in section 197A, a certificate as required by section 203 and return under section 206 and 206C and statements under section 200 subclause 2A or section 200 subclause 3 or the proviso to the section 206C, etc. So the penalty for these offences will be 10,000 for each failure or default. Now section 272 AA subclause 1, 272 AA subclause 1. So here failure to comply with section 133B and the penalty will be not exceeding rupees 1,000. Now section 272B, failure to comply with the provisions of sections 139A, 139A subclause 5 subclause C or 139A 5A, 139A 5C. For failure to comply with these sections, the penalty will be 10,000. Section 272BB subclause 1, that is 272BB subclause 1. Failure to comply with section 203A. Here the penalty will be 10,000 for each failure or default. Now section 272BB subclause 1A. Quoting false tax deduction account number, tax collection account number, tax deduction and collection account number in challans, certificates, statements, documents referred to in section 203A subclause 2 and the penalty will be 10,000. So these are the offences or penalties that is discussed under Income Tax Act, and how does the prosecution takes place, that we shall look into it.
Income tax is one of the major sources of revenue of the government. It occupies the dominant place in direct taxes. The administration and collection of income tax is vested in the central government. However, the net proceeds of the tax, that is gross amount of tax collected, less collection charges, are apportioned between the central and state governments. The following are excluded from the divisible pool. That is 1. The corporation tax, income tax on companies. Then the proceeds of tax attributed to union territories. The third one, tax payable in respect of union emoluments paid out of the Consolidated Fund of India. And the fourth one is surcharge of income tax for purpose of the union, if any. So these are excluded from the divisible pool. Now, the amount excluded from the divisible pool goes to the central government. The principle regarding the distribution of the remaining amount are determined by the Finance Commission. In India, tax on income other than agricultural income is levied and collected under the Income Tax Act 1961. The Parliament enacted the Income Tax Act 1961 in the exercise of its powers conferred under Article 246, read with Entry 82 of List 1 of the 7th Schedule to the Constitution of India. The Income Tax Act 1961 is hereinafter referred to as the IT Act 1961. The Article 270, taxes on income other than agricultural income shall be levied and collected by the Government of India and distributed between the Union and the State as per the recommendation of the Finance Commission. So, by Article 270, taxes on the income other than agricultural income shall be levied and collected by the Government of India and distributed between the Union and the State as per the recommendation of Finance Commission. The law relating to the income tax is contained in the Income Tax Act 1961, the Income Tax Rules 1962, the Annual Finance Act, the circulars, notification and orders of the Central Board of Direct Taxes, executive instructions of the department regarding procedural aspects of the collection of tax, the judgments rendered by competent courts of law. On every year, the Parliament passes the Finance Act. It fixes the rates of tax for the relevant assessment year, rates for the deduction of tax at source, and advance payment of tax. The Finance Act may also make substantial amendments to the Income Tax Act 1961. If an assessment year of the Finance Act is not passed on 1st April, the tax shall be charged other rates in force in preceding assessment year or at the proposed rates in the finance bill then before the Parliament, whichever is favourable to the assessee. So, if an Finance Act is not passed for a particular assessment year by 1st of April, the tax shall be charged at the rates in force of the preceding assessment year or at the proposed rate in the finance bill then before the Parliament, though it is not enacted, the particular finance bill which is then before the Parliament, in which manner, whichever is favorable to the assessee. So this brings to assessment year and previous year. Assessment year means the period of 12 months commencing on the first day of April every year and ending on 31st day of March. That is 1st April to 31st March. That is assessment year. It is also called financial year. The current assessment year is 2022-2023. The current assessment year has begun from 1st April of 2022 and it will end in current assessment year, if it is 2022-2023, it will start from 1st April of 2022 and end by March 31, 2023. The next assessment year will be 2023-2024, which will start from 1st April of 2023 and end in 31st March of 2024. The previous year means the financial year immediately preceding the assessment year. So if we are looking at 2023-24 as the assessment year, the previous year will be 2022-2023. Means so previous year means the financial year immediately preceding the assessment year. The previous year of the current assessment year will be 2022-2023. Today is 15 November 2023. So the current assessment year is 2023-2024 and the financial act that is existent is 2023, Act of 2023. And here, okay, so the previous year for this current assessment year will be 2022-2023. There are certain exceptions to the general rule that the income of the previous year is accessible to tax in the next assessment year. The exemptions are income of non-resident shipping companies if they do not have any representatives in India, income of persons leaving India either permanently or for a long period of time, income of a person trying to alienate his asset with a view to avoid tax, income of a discontinued business. So usually we for the assessment year of 2023-2024 we track down the gross income of 20 during the year previous year 2022 to 2023. But there's an exception, that is there are certain exceptions to the general rule that income of the previous year is accessible to tax in the next assessment year. So what are the exceptions? So if there is an income for a non-resident shipping company and they do not have any representative in India, then that income is taxed at the same year when it is received. Now, income of a person leaving India either permanently or for a long period of time. So in this scenario, the person will not be present or the income cannot be assessed for the next assessment year. So it is assessed in the same year as the income is received. Similarly, income of a person trying to alienate his asset with a view to avoid tax and income of a discontinued business. Now, who are liable to pay tax under Income Tax Act, or who is an assessee? Or you can say, what is the rate of tax applicable to different assessees? So we also already read that the rate of tax will depend upon the Finance Act. Now, who is an assessee? An assessee is a person who is liable to pay income tax or any other sum of money payable under the Income Tax Act of 1961. Every person whose total income exceeds the non-taxable limit is an assessee under Income Tax of 1961. The following persons are liable to pay income tax under Income Tax Act of 1961, that is individuals, Hindu undivided family, company, firm, association of persons or body of individuals whether incorporated or not, local authority, even artificial jurisdictional person. Now, then we have, what is a surcharge? In addition to the income tax, every assessee has to pay 10% of the income tax where taxable income is more than 50 lakhs and up to 1 crore as surcharge. However, the amount of income tax and surcharge shall not increase the amount of income tax payable on the taxable income of Rs 50 lakh by more than the amount of increase in taxable income. In addition to the income tax, every assessee has to pay 15% of the income tax where taxable income is more than 1 crore. So, with respect to this, we have cess, fee, and then there is relaxation for senior individuals and super seniors. So there is a difference in tax rate for people aged above 60 years and people aged above 80 years. These change in rates varies every financial year and it is dependent on the Finance Act. Now, what is with respect to partnership firm companies, everyone is also taxable under Income Tax Act. Now, what is income? We are taxable for income. So, what is income? Section 2 subclause 24 of the Income Tax Act 1961 defines income. Income tax is annual tax on the income of the assessee. Income of the previous year is charged to tax in the next following assessment year at the rates of tax applicable for that assessment year. So, by virtue of Section 2 subclause 24, the expression income it's an inclusive definition. It includes profits and gains of business and profession, dividends, voluntary contribution received from religious or charitable trust or institutions. If the contributions are made with specific direction that they shall form part of the corpus of the trust, it will not become an income. Value of perquisites or profits in lieu of salary, any special allowance or benefits granted to the assessee to meet his expense from the performance of his duties of an office or employment of profit, export incentives, any interest, salary, bonus, commission or remuneration earned by a partner of a firm, capital gains, profit and gains of any business of insurance carried on by mutual insurance company or a corporate society, then profits and gains of any business of banking carried on by a corporate, and so on. Basically, we can say there are 5 heads of income, that is salary, income from house property, then we have profits and gains from business, then we have capital gains, and then we have other sources, the dividends, security bonds, all comes are other sources. Now, keyman insurance policy. What is a keyman insurance policy? So, if you are running an industry and there is 2 employees who is the main soul of the company. For example, you are running a bakery and you have a hit product called A, and only 2 persons know the recipe of A. So in this situation, if there is an injury to these 2 individuals, the recipe of A will be lost and your bakery or your company is going to cannot function anymore. So in that case, these 2 people will become the key man for the functioning of the company. So the employer himself will find insurance or keep the people these 2 key persons in insurance. So such policies will be keyman insurance policy. Keyman insurance policy is a policy taken on the life of one person by another person in whose organization the first person plays a key role. The relationship between these 2 persons could be that of employer-employee or that of a principal and an agent. If a premium is paid on such policy, it can qualify for deduction as a business expenditure if it can be established that the policy has been taken on the life of a such person in the interest of the business. As regards the treatment of the maturity proceeds of a keyman insurance policy, it is treated as income for the purpose of Income Tax Act 1961. The exemption available under Section 10, subclause 10D of the Income Tax Act 1961 in respect of maturity proceeds of a life insurance policy is not extended to the proceeds of a keyman insurance policy. Now,
So that is in short with introduction to Income Tax Act.